Like and subscribe and click the bell icon to get new video updates.
The risk of liar loans. Can overstretched borrowers cope with higher interest rates? By Clancy Yates, May 4, 2022, 7:45 p.m. Save login, register or subscribe to save articles for later. Share normal text size, larger text size, very large text size 119. View all comments. In an era of booming house prices and fierce competition for properties, tales of Australians pushing the envelope with their mortgage applications, usually by fudging expenses to maximize borrowing power, have not been uncommon. Hedge fund manager John Hempton and economist Jonathan Tepper famously sought to expose these so-called liar loans in 2016, pretending to be a gay couple on the hunt to buy property in Sydney's West. They reported being coached by mortgage brokers on how to get supersized loans approved by banks, prompting them to short a housing market they thought was a massive bubble. An estimated 22% of owner-occupiers only had emergency funds to cover 2 months of repayments. Credit: Bloomberg house prices have, of course, risen sharply since then, fueled by ultra-low interest rates. But with mortgage rates now rising for the first time in nearly 12 years, the spotlight is back on banks' vast home loan portfolios, and the risk that some borrowers overstretched themselves to get into the market. And with interest rates set to keep rising, Goldman Sachs analysts now expect the cash rate to hit 2.6% by the end of the year. The key question is whether these overstretched borrowers will be able to cope. Investment bank UBS released a survey last month looking at how rigorously banks assess borrowers, which included asking if people fudged some part of their loan application. The survey of 860 people concluded that 37% of the mortgages on Australian banks' books were misrepresented loans, down from 41% a year earlier, suggesting a modest improvement in lending standards. Yet despite the improvement, UBS predicted higher interest rates would expose vulnerabilities. For example, the survey found about 22% of owner-occupiers only had emergency funds to cover 2 months of repayments, though more than half of borrowers were more than 3 months ahead on their repayments. Of the big four banks, UBS claimed ANZ's bank's lending was at odds with peers, after it said more than half of the respondents who took out a loan with ANZ had misstatements in their application. ANZ's chief executive Shane Elliott dismissed these claims on Wednesday, saying the survey was done using a really small sample, and it had a ridiculous margin for error, given the bank actually has about 1 million customers. On the more general issue of people lying on their loan applications, Elliott said banks were required by law to check the information provided by customers, which includes going through bank statements with a fine-tooth comb. While it's sad that people feel the need to mislead or lie on their loan applications, we do not take our customers at their word, and actually the law requires that we do not, Elliott said. Even so, others who are more pessimistic about the property market, such as digital finance analytics founder Martin North, believe the ongoing debate about liar loans highlights the risk that some people have stretched themselves too far to buy property. While it's sad that people feel the need to mislead or lie on their loan applications, we do not take our customers at their word, and actually the law requires that we do not. And CEO Shane Elliott, is it a liar loan, or is it being encouraged by mortgage brokers, for example, to present your information in a particular way because they know how to get it through the system? North says. North, who has long had concerns about the high level of household debt, worries that rate hikes could be part of a perfect storm slowly brewing in housing, alongside rising cost of living, falling house prices, and stagnant income growth. North says his monthly surveys of 4,500 people show more than a third have problems with their cash flow, though he also says it will take a couple of years for the full extent of mortgage stress to emerge. Many market observers also believe high household indebtedness will mean the RBA needs to tread carefully in raising rates. Hempton, of Bronte Capital, puts it this way: the question is how far can the Reserve Bank push up interest rates before they cause real pain in this economy? And I think the answer is not very far. As things stand, The number of people getting into trouble with their home loan repayments is very low. Anzes Elliott described his bank's credit quality as amazingly benign on Wednesday, saying 0.7% of its borrowers were behind on their home loan, compared with 1% normally. An analyst at S&P Global Ratings, Erin Kitson, says there are a number of mitigating factors that,